Hi guys. Are we back with our continuing with our ratios, our analysis and interpretation of financial statements? Today I'm doing task 4.16 and I would like you to do task 4.15 as homework. Please remember to send me your homework by screenshot and I will then send you the solution for you to mark. Okay, so task 4.16 and a few of the activities before it are all about returns, earnings, and dividends. Okay, so we call these the return ratios because these basically shows that as a shareholder, you have made a certain investment in the company and you need to know if that investment is worthwhile. Like, should you keep your shares in the company? Should you sell your shares? Should you think of buying new shares? As a new shareholder, a potential shareholder, you'd also like to make the decision, should you actually buy shares in the first place? So these are very important. They come up in a lot of questions and they're obviously always up for interpretation as well. Um, out of these three ratios, the return on shareholders' equity is similar to the return on partners' equity that you did last year. But obviously this time it's going to be on shareholders' equity. Earnings per share and dividends per share are new ratios for this year, but they're quite easy to calculate. Remember, most of the time you again will be given these formulae in your answer in your formula sheet. However, you will have to know what the formulae are because they will not be labeled. Okay, so let's start with task 4.16 for Wembley Limited. The following figures were extracted from the balance sheet and we've got some information there. The first one we have to calculate in 4.16.1 is the return on shareholders' equity. So I have typed out the formula here, return on shareholders' equity, abbreviated to ROSHE. The formula is net profit after tax divided by average shareholders' equity. I put a note here on the side to remind you that shareholders' equity is equal to ordinary share capital plus the retained income. When the formula requires average, though, we're going to take the ordinary share capital and retained income for this year plus the ordinary share capital and retained income of last year and divide it all by 2. So remember, whenever we use averages in any formula, we take the 2 years figures and divide it by 2. Okay, net profit after tax, you should be all familiar with that. It is the net profit after tax has been subtracted, or else you can also refer to it as the final line on the income statement, which is called the bottom line. Okay, so let's look in our question for the net profit after tax. Okay, so we've got the income statement information. The net profit after tax is given to us in the third line. So it is 150,000. Okay, just going to underline that so you can see that. Okay, average shareholders' equity. Okay, so shareholders' equity is ordinary share capital plus retained income. Average, that means you're going to take the figures for this year, the figures for last year, add them all up and divide by 2. The order doesn't matter. So 4,330,000 ordinary share capital of this year plus 180,000 retained income of this year. 3,280,000 ordinary share capital of last year and 170,000 retained income for last year. Okay, so that's the denominator. We're going to multiply it by 100. Okay, remember, it's called return on shareholders' equity. And I told you in one of the previous exercises that when something is called a return, we multiply it by 100 because we need it to be a percentage. Okay, so we're going to do the calculation. Remember, I told you now this step would not be necessary in exams. Your marks would be in this step here. So this is the important step. And when you're doing this, you can see there are quite a few figures involved. So there would be quite a few marks involved. You could probably look at it as about a mark per figure, and in this case it would be about 5 marks just for that part, right? Okay, I'm just going to calculate this. You could put all this in your calculator, but please make sure that you do it correctly if you do so. Okay, we're going to multiply the answer by 100 because we need it to be a percentage. Okay, percentage, you must put the percentage sign, and we are rounding off to one decimal place, so 1,9%. Sorry, I forgot to divide this by 2. I'm just going to do that quickly. Remember, average is all those figures added up and divided by 2. Right? So there we go. That's the return on shareholders' equity. Okay, so can you see the return is 3.8%. Okay, I'm just going to put a note here that we'll compare this to the previous year. Okay, and to returns earned on other investments. Okay, now if you look at this, 3.8% looks quite low. Okay, normal return would be about 12% or more, right? But we can see what else the question holds for us. Okay, the next formula we need to calculate is earnings per share. The formula is net profit after tax over the number of shares in issue. Whenever you see a formula which says per share, you're always going to be dividing by the number of shares in issue. And this one here is not called return on something, it's just earnings per share. But you'll see it is, you also have to multiply it by 100. In this case here, our final answer is going to be in cents. That's the reason you multiply it by 100, right? So net profit after tax, the same net profit after tax we had, 150,000. And the number of shares in issue. Now you don't have to worry about the beginning of year or any shares, additional shares or repurchase of shares. We only care about how many shares were in issue at the end of the year. So it says here that there were 1.5 million ordinary shares issued on 31st August 20.3. That was the beginning of the year. And then it says that the issue of 500,000 new shares was made on the first day of the 20.4 accounting period. So our number of shares in issue will be the number of shares that they had, 1.5 million, plus a new issue of 500,000. So it's going to be 2 million. Sorry, I don't know why it's underlining. Okay, you're going to multiply your answer by 100 because you want it to be in cents. Okay, and then we're just going to do the calculation. Okay, again, multiply by 100. Okay, so our answer is 7.5 cents. Okay, our next formula is dividends on ordinary shares. Again, we're dividing by the number of shares issued, so we're going to use the same figure of 2 million. Right? Dividends on ordinary shares. You must remember that. Think back to our ledger accounts. What went into dividends on ordinary shares? And it was the interim dividend plus the final dividend together. You can also get this information from note 9, which you should know is the retained income note. Okay, so dividends on ordinary shares, let's look at what our question has. We've been given the retained income note on page 228, and the dividends on ordinary shares is in brackets there, 140,000. So 140,000 is our numerator. The denominator is the same number of shares we used just now, so 2 million. So I don't know why this is underlining all the time. Okay, you're going to multiply your answer by 100. Also because you want your answer to be in cents. Okay, let's just work out the final answer. So it's going to be 140,000 divided by 2 million shares. Multiply your answer by 100 because you need it to be in cents. Okay, so those are the three formulas which are called the return ratios. Okay, this shows what return the shareholders are earning on the investment in the company. Okay, and the final part of the question, which is always the most important part, so 4.16.2, where it says, comment briefly on your findings, and the corresponding figures for the previous year are. They've given us the figures for the previous year. Now, with ratios, most ratios, one of your easiest comparisons will always be to compare it to the previous year. So do you see the return on shareholders' equity was 10%, and we have now calculated it to be 3.8%. So it has definitely decreased. The earnings per share was 20 cents, and it is now 7.5 cents. The dividends per share was 10 cents, and it is now 7 cents. Okay, so overall, just by looking at this, the trend has been that all three of these indicators have decreased substantially. So the shareholders will not be satisfied with the return that they are earning in the investment. Old shareholders will feel that the company is not doing as well as it was in the past. New shareholders will also be concerned that there's a downward trend in the performance of the company and may not want to make an investment. Right? So let's put all this down in words. Okay, so we're going to say that the return on shareholders' equity has decreased. Sorry, does that changes? The return on shareholders' equity has decreased. You don't just say it has decreased. You can say it has decreased from 10% to 3.8%. Okay, if you've got time, you can work out the difference. So you can say 10 minus 3.8, which is 6.2%. Okay, then we're going to do the same thing for the earnings per share. It has decreased. This time we can say it has decreased by the number of cents. It was 20 cents and it is now 7.5 cents. So 20 minus 7.5, you just work that out. 20 minus 7.5. Just the earnings per share has decreased by 12.5 cents from the previous year. Okay, and the dividends per share has also decreased. The dividends per share has decreased by 3 cents. Okay, so the return on shareholders' equity, we've got an answer of 3.8%. We've compared it to the previous year. We can also compare it to the return earned on other investments. So if your company has a loan or fixed deposit, you could compare it to that interest rate. Okay, we can also say it is very low compared to returns earned on fixed deposits or loans. Okay, normally this is about 12-15%. Okay, the earnings per share and the dividends per share can also be compared to each other. So if you look at it, the company earned 7.5 cents per share. So that means the profit is 7.5 cents per share. Out of the 7.5 cents per share, 7 cents were distributed as dividends. So the remaining 50 cents was basically kept as retained income. Okay, so this is so another thing we can do is calculate the retention rate. Okay, so I'm just going to do that. Okay, the retention rate. Okay, which remember the retention rate is the difference between the earnings per share and the dividends per share. Okay, so this tells you how much was retained by the company. Okay, and you can see that a lot was not retained by the company. Okay, only 50 cents. Okay, so we can say that only 50 cents of profit earned per share was retained by the company. Okay, so this doesn't bode well for the future as well. So that means that the retained income is not as high as it was in the past, or they haven't retained enough. And you can look at the retained income balances. We started off the year with 170,000 and we're ending off with 180,000. So it's only another 10,000 rand that was added on there. Okay, so basically, if you want to draw a conclusion on this, we're going to say that the shareholders will not be satisfied with the return they are earning on with the return they've earned on the investment, and may consider selling their shares. Okay, a potential new shareholder, somebody who's thinking of buying shares, will decide not to buy those shares. Okay, so this is task 4.16. Please do 4.15 for homework and send it to me on WhatsApp. Okay, thank you. Bye.